Hey everyone, welcome back to Corporate Decoder, the place where we unravel the juicy secrets hidden in plain sight within corporate filings. Today we are diving deep into Conagra Brand's Q2 2026 report, and let me tell you, there are some interesting moves happening. Before we jump in, if you love getting these unfiltered financial insights, make sure you smash that subscribe button and ring the bell. Also, come hang out with us on Discord. The link is in the description below. Alright, Team Conagra Brands Incorporated. We are looking at their Q2 earnings report for the period ending the 23rd of November 2025. This is a big deal because it gives us a snapshot of where a major food company stands in a pretty rocky economic landscape. We're talking about a company that basically powers a good chunk of your pantry with brands like Bird's Eye, Healthy Choice, and Slim Jim. First up, let's talk sales. For the 13 weeks ending the 23rd of November 2025, Conagra brought in $2.979.1 billion in net sales. Now that sounds like a lot, but it's actually a drop from the $3.195.1 billion they made this time last year. Over the longer 26-week period, the story is similar with sales falling from $5.99 billion to $5.611.7 billion. This means Conagra is selling less stuff overall than they were a year ago. Think of it like this: if they used to sell 100 bags of chips, they might be selling closer to 94 now. Following that trend is gross profit, that crucial number that shows how much money is left after the cost of making the product. For the 13-week period, it dropped from $846.7 million to $696.0 million, and for the 26-week look, it fell from $1.586.0 billion to $1.336 billion. This paints a picture of higher costs eating into their profits, even though they are selling goods. Now take a look at this big one, goodwill impairment charges. In the 13-week period, they hit $771.3 million. That's a huge chunk of money, and it happened again in the 26-week period for the same amount. What does this mean? Well, goodwill is basically an accounting figure that represents how much extra a company paid for another business above its identifiable assets. When a company takes a goodwill impairment charge, it means they've decided that business they bought isn't worth as much as they thought. It's like buying a used car that looked great, but then realizing it has engine problems, so it's not as valuable as you initially thought. This big charge points to some serious struggles, especially in their refrigerated and frozen segment, where a $771.3 million impairment took place. This signals that a significant portion of their previous acquisitions in that area has lost value on paper. Under that, we see loss gain on divestitures. For the 13-week period, it was a loss of $597.6 million. This is directly tied to the sale of businesses. They reported a gain of $42.7 million from selling their Chef Boyardee business. They also sold their frozen fish business, resulting in a loss of $500,000. These divestitures are part of Conagra's strategy to streamline the business and focus on core brands, trimming away units that may not be performing as well. And the bottom line. For the 13 weeks ending the 23rd of November 2025, Conagra reported a net loss of $663.6 million compared to a net income of $284.5 million in the same period last year. That is a massive swing from profitable to losing money. For the 26-week period, it was a loss of $499.1 million compared to a solid income of $751.4 million a year ago. This significant drop in profitability is a major red flag and is largely driven by those hefty impairment charges and divestiture-related losses. Now, these notes at the bottom of the tables are crucial. They'll explain all those little details and adjustments that make the numbers in the tables understandable. They are the backbone of understanding what is truly going on behind the scenes. Let's shift gears and look at the balance sheet, the snapshot of what Conagra owns and owes. As of the 23rd of November 2025, their total assets stood at $19.540.3 billion. This is down from $20.933.9 billion last May. A big reason for this decrease is the goodwill figure. It dropped from $10.501.9 billion to $9.729.4 billion, which is directly tied to those impairment charges we just discussed. It shows the company is actively devaluing assets that are not performing up to expectations. On the flip side, their total current liabilities were $3.619.7 billion in November 2025, down from $4.317.0 billion in May. That reduction in short-term obligations is a positive sign for their immediate financial health. And for stockholders' equity, it's sitting at $8.090.8 billion, down from $8.932.7 billion. This decrease is largely due to the net loss recognized during the period, further impacting the equity value. Switching to cash flow, things get interesting. For the 26 weeks ending the 23rd of November 2025, Conagra generated $331.2 million from operating activities. This is down from $754.2 million a year ago. This drop in operating cash flow means the core business is bringing in less cash. Usually this would be a big concern, but it's somewhat explained by factors like lower profits and changes in how they manage their inventory and receivables. They are actively trying to collect money faster and manage inventory levels, which can temporarily affect cash flow. In investing activities, they spent $218.6 million on property, plant, and equipment. This shows they are still investing in their physical assets for future growth and efficiency. Financing activities show a significant repayment of long-term debt amounting to $1.02 billion. They also issued new long-term debt totaling $1 billion. This signals a strategic move to refinance their debt, essentially swapping out older debt for newer, potentially more favorable terms. They also paid out $334.8 million in dividends to shareholders, which shows a commitment to returning value to investors even during a tough financial period. Digging into the notes, we see Conagra using US generally accepted accounting principles. They mention some upcoming accounting changes like improvements to income tax disclosures and disaggregation of income statement expenses. These are mainly about how they report information to be more transparent and detailed, which is always good to see. It's like them saying they will provide a clearer picture of their financial health moving forward. They've been busy making acquisitions. In July 2024, they bought a cooking spray manufacturer. Then in August 2024, they acquired Sweetwood Smoke Suriname, company maker of fatty branded meat sticks. These moves show Conagra is strategically expanding its portfolio in areas they believe have growth potential. The goodwill from these acquisitions is attributed to expected synergies and future growth opportunities. Now this section is packed with action. They completed the sale of their Chef Boyardee business for $607 million in early 2026. They also sold their frozen fish business, including Van de Kamp's and Mrs. Paul's brands. These divestitures are key to their strategy of shedding underperforming or non-core assets to focus on stronger brands. They also sold their stake in Agrotech Foods Limited way back in 2025. The company is clearly reshaping its business portfolio. Conagra is also undergoing a restructuring plan aiming to improve efficiency and streamline their supply chain. They've incurred significant charges for this plan and expect it to continue through 2026. This is a common strategy for large companies to cut costs and become more competitive. It's like a major renovation project for the business. This is where we see their debt management. They repaid a $1 billion senior unsecured note and issued new notes adding up to another $1 billion. They also prepaid significant term loans. Their revolving credit facility is a substantial $2 billion unsecured agreement. Despite the debt, they are within their required financial covenants, which is a positive sign of their ability to manage their obligations. As of November 2025, they had $348 million outstanding under their commercial paper program. We already touched on the goodwill impairment, but here we see the numbers broken down by segment. The refrigerated and frozen segment took the biggest hit. They also recognized impairments on brand intangible assets like Bird's Eye and Earth Balance. This indicates that the economic headwinds are affecting the value of these established brands on their books. It's a clear sign that even strong brand names can lose value when market conditions shift dramatically. The report mentions a 150 basis point increase in the discount rate, reflecting heightened macroeconomic uncertainty driving these decisions. Conagra uses derivatives to hedge risks like commodity price swings and currency fluctuations. In the 13-week period, they recognized $1.4 million in derivative losses in general corporate expenses. For the same period last year, they saw gains of $10.9 million in gains. This is normal business practice to manage volatile costs, but it does add some fluctuation to their earnings. They incurred stock-based compensation expense of $13.5 million in Q2 of 2026 and $33.1 million for the first half. This is a significant cost related to their employee stock option and award plans. Basic and diluted earnings per S-Hair took a beating. For Q2 2026, they reported a diluted loss of $1.39 per S-Hair, a stark contrast to the $0.59 earnings per S-Hair in Q2 2025. For the first half, the loss widened to $1.04. per hair compared to earnings of $1.57 per hair last year. This reflects the overall drop in net income. Their income tax expense saw some fluctuations too. For Q2 2026, it was $8.3 million compared to $61.5 million in Q2 2025. The effective tax rate was actually negative in Q2 2026 at negative 1.3% due to those goodwill impairments that have tax benefits. The first half of 2026 saw a tax expense of $132.9 million compared to a tax benefit of $77.4 million in 2025, largely influenced by changes in deferred tax assets and valuation allowances. This section covers ongoing legal matters. They are facing product liability claims related to their cooking spray products and have paid out significant amounts in settlements. They also resolved legacy litigation related to lead-based paint. While they believe they have adequate provisions for these matters, there is always a possibility of future material impacts. Conagra reports through 4 segments: grocery, Hadiamp, snacks, refrigerated Tadiamp, frozen, international, and food service. Net sales are down across most of these segments, with grocery, Hadiamp, snacks, and refrigerated Tadiamp, frozen indicating drops in organic volumes. The food service segment saw an increase in price mix due to inflation-driven pricing actions, but volume also decreased. The company is clearly navigating inflationary pressures and changing consumer behavior across all its business lines. So what does all this mean for Conagra Brands? Let's break it down. The company's direction shows a clear effort to streamline and focus on core strength through divestitures and strategic acquisitions. They are also actively managing their debt profile. However, the substantial goodwill and intangible asset impairments reveal that some of their past strategic decisions, particularly regarding acquisitions, have not materialized as expected, leading to significant write-downs. This indicates a weakness in accurately valuing future performance or a significant deterioration in market conditions for those acquired businesses. The business sentiment seems cautious to say the least. With rising inflation, supply chain issues, and weak consumer sentiment, Conagra is facing considerable headwinds. They are trying to offset these with productivity initiatives and pricing actions, but it is clearly a tough environment. The drop in sales and segment operating profit across the board signals that these external pressures are having a real impact on their top and bottom lines. Looking at the numbers, the shift from strong profitability to a significant net loss highlights the challenges. The impairment charges are a major concern, showing a potential miscalculation in past investments or a severe downturn in specific market segments. While they are actively managing debt and returning capital to shareholders through dividends, there is a clear need for improved execution and market adaptation to regain profit momentum. In conclusion, Conagra Brands is in a period of significant business transformation, facing both internal challenges with asset valuations and external pressures from the economy. Their ability to successfully navigate these challenges by improving operational efficiencies, growing their core brands, and making smart strategic moves will be crucial for their future success. For now, it's a story of tough adjustments and a company actively fighting to regain its footing. Alright, that is our deep dive into Conagra Brands' Q2 2026 report. What do you all think about these numbers and the company's strategy? Let me know your thoughts in the comments below. If you found this breakdown valuable, please hit that like button. It really helps us out. And of course, if you want more of these corporate financial dissections, make sure you are subscribed. Don't forget to join the Discord community too. The link is in the description. Thanks for watching this episode of Corporate Decoder. See you in the next one.